Good evening. Hi there. How you doing? When I was a lad, maybe about 9, 10 years old, my mum took me down to the post office in Kentish Town and opened up a post office savings account. And it was only for probably less than maybe 50 pence, or in today's money, probably less than £1 at the time. But it seemed like a lot to me, and she wanted to encourage me to save money. And I've still got that book somewhere because it was an old paper kind of book that they used to give you and stamp it and write it by hand and stamp it as you put more money in or drew money out. And the post office tried to get the book off me. They said, "We're changing the book, send it back." And I didn't send it back. I didn't have much money in there as I used it over the years. And I didn't have a proper bank account until my late teens, 17, 18 or something, when I actually, 16, 17, something like that, when I actually opened a proper bank account with a checkbook. I'd always just used this post office savings account. And that post office, then when they hived off the post office, because it all used to be, the post office used to be the post office bank, and the telecoms, the telephone system, and what's now British Telecom used to be just part of the post office. It was all government owned, nationalised business. And then it was eventually hived off, and it became National Savings, and now it's NS&I, National Savings and Investments. And they are offering the best rates for savings. If you just want to open a simple account, put the money in and take it out and not have any tie-ins, they're paying 1% with no minimum payments or early withdrawals. And that's probably about the best savings rate you can get in the UK at the moment. And it's rock solid because it's a government-owned institution. So you haven't got any fears about a bank collapsing or whatever. It's just there. I think you can find the website. Just look up National Savings. I think it's NS&I, and I.com. So that's NS&I.com to get all the rates. They also offer a premium bond, which is the old premium bond, which is a bit like a lottery where people put money in and they pay out prizes every month. They say it's equivalent to 1.4% variable rate over the years, but you could win a prize of 50, up to £1 million in a premium bond. I had one years ago. I'm not sure I've got it anymore, but I never won anything on it. There's also a junior ISA paying up to 3.25%, which is tax-free. There's income bonds where you can tie your money up for longer, paying 1.15, 1.16, and there's ISAs and direct savers and different types of accounts. Now, these don't sound very exciting rates, but with base rates at almost at zero at the moment, it's not bad. And the reason they're paying this is because the government need to raise money. The government need to raise money to pay for all this stuff that they're doing. All these Boris bike lanes and all the furlough schemes and the retention schemes and the bounce back loans that they're guarantees and the grants and all the help they're doing for business, and which includes rate support, council tax support. All that stuff is going to cost something like 300 billion over the years, and that's before we've seen unemployment rise. So they need money, and one of the ways of raising money is to get the public to invest in government-backed bonds, like they did in the war bonds in America and the UK. They raised billions through these war bonds, these posters. "We need you," that finger pointing at you, Lord Kitchener. And this is a way of raising money. So they've been told they've got to raise 35 billion. So they put the rates up. The banks are not going to be happy because they're not competitive at the moment. So it's a good way to save. Now, there is another scheme called Help to Save, where this is an unbeatable thing. You put the money in, and then after a certain amount of time, they give you a 50% bonus. However, it is only for people on very low incomes, probably effectively people on sort of income support, universal credit. But it's there. It's designed to help the lowest paid try and save some money rather than always be dependent on, not only the state, but always be dependent on credit, which can be very, very expensive. And I'll come on to that in a second, because the lowest paid and the people with the least amount of money all seem to pay the most for credit and loans. The more well-heeled you are, the better rate you'll get on a mortgage and on a loan, etc. People will just throw money at you at very low rates, but people who really need the money always seem to get the raw deal. And there is something also called a lifetime ISA, where you get a 25% bonus if you invest up to £4,000, and it's aimed at first-time buyers aged 18 to 39. This replaced the rather better scheme, which was the Help to Buy ISA, which was phased out last year. But it's still a way of earning 25% bonus. So, on £4,000, you can get £1,000 added on. You can't get that anywhere in a guaranteed type of investment, so it's still worth having. Now, the reason I mention this is because, after I've always been interested in money, and I went into financial advice myself, and I was in financial services for 25 years, working for banks, insurance companies, and for myself. And then I wrote a book about money called Yes, Money Can Buy You Happiness. And over the years, I've seen thousands of people and looked at their financial situation and found that most people don't save very much. They don't have much backup savings. And we can see this now with all of the coronavirus stuff going on, that people who've worked all their lives and say, well, I've lost my job, or I'm on furlough, I've got no money. They say, I can't afford my rent, or I can't afford my mortgage, I've only got a month's money left. And it's true that most people are no more than about 3 paychecks away from bankruptcy or financial disaster or losing their home. And this is true of people, I think particularly in Britain and America, maybe not so in countries like in Germany and Europe and places like that, and other European countries, and in Japan, where people do save a lot of money. We've got out of that habit of saving, and we're more into spending and getting fast credit, which I think should be just called fast debt. It's not fast credit, it's just a fast way of getting into debt. And we know that credit cards throw money at people. We know that credit cards give people far too big a credit limit. People can routinely get £5,000-10,000 credit limit just like that. And then when you go up to it, they send you a letter saying, would you like a bit more? We can increase your credit limit. Sometimes they do it automatically. And this is because people haven't got any contingency fund. They haven't got any savings whatsoever. So, far from, we're not even talking about pensions here. We're just talking about emergency contingency funds that you need when your car breaks down, the washing machine goes, and you need £500. And what do you do if you haven't got that little bit of savings? Well, you go and start borrowing money. There's even an ad on TV where the ladies, this woman comes out with her 3 kids, and the washing machine's broken. They say, I haven't got any money to fix it. And then this bubble appears, and somebody's talking to her saying, oh, we can give you money. And it's something like the Wonga.com type of situation. And they said, we'll have that done in a jiffy. And the nice friendly face. And people don't realise that they're paying a lot of money for this sort of credit. In fact, some of these short-term credit loans and credit companies and payday loans and the Wongas, they can charge an annualised rate of over 90%. Yeah, 90%. Now, people don't see it that way because they say it's not 90%, I'm only paying 25%. Well, no, you're paying 25% for 3 months or 2 months, but the annualised rate works out at maybe 90%. Now, I'm just giving a blunt example there, but if you're borrowing money for 3 months and you're paying X amount, that's not the annualised rate, that's not the real rate. So if you borrow £500, for instance, and they're adding on interest of say £160, that is not really just what you think it is. That is not that rate works out to over 90%. So you've got to be very careful about borrowing this and look at the APR, which is the annualised percentage rate. Now, lenders say, well, it's nothing to do. APR is irrelevant because we're not charging the loan over a year. Same if you go to a pawnbroker and you pawn your gold ring or something, and they give you money. That could be very, very expensive borrowing. So it's always worthwhile having a little bit of money put aside so that you don't need to go to these sort of companies. And the lowest paid, the people who are really on the breadline, they end up with loan sharks who can charge rates of into thousands of percent, 4,000%. These illegal lenders and what they used to be called loan sharks, and they're the worst ones. And people can get really tied in badly with these people who sort of knock on your door. So be very careful of that. But even the high street banks, the legitimate banks, they're charging over 40% for an overdraft now. And the credit card companies are still charging 16, 20% routinely, sometimes even 30% on a credit card, despite the fact that we've got historically low base rates. Now, base rates means that the banks can get hold of this money at virtually next to nothing, and they're lending it out to us at 16 to 20 to 30 to 40%, which is a complete rip-off. Even mortgages, if you're getting a mortgage of 3%, it sounds low, but really, when the rate that they're getting the money is almost minuscule, they're making more profit on that than when they were making giving out mortgages at 12% when the base rates were at 10%, if you know what I mean. So, the borrowing money is very, very expensive at those sort of rates. And if you do need money, I think you should go to things like credit unions or look for cheaper ways of getting borrowing money if you do need it. But borrowing money to buy consumer goods, as Warren Buffett said, is a pretty dumb idea. Borrowing money on credit cards to buy stuff that goes down in value is bad borrowing, it's dumb borrowing. And that's why Warren Buffett owns credit card companies. He owns a piece of Visa and MasterCard and several banks. So he said he even admits it's dumb, and yet he makes a lot of money lending to what he would call dumb people, if you like, people who are perpetually in debt, and it can be a big problem. He also said that, someone came to him and asked for advice on investing a small amount of money, and he said, well, have you got any credit card debt? And the person said, yes. He said, what are you paying on that? And they said, 18%. He said, well, just pay that off. I can't, even if I put you in my best fund, I can't promise to make you 18%. So he can't make that. So why not just pay off the debt instead of, having said that, you still need some emergency contingency fund. And, I'm just saying that at the moment, depending on when you're listening to this, national savings is a pretty good deal because the government are backing them and the government want to raise 35 billion. So they're upping the ante and paying the best rates on national savings. So there you go. So I've still got my old post office book. I haven't put much money in it recently. It's probably an obscure account. I've just kept the book as a souvenir. It might sound a bit nerdy, but I sort of collect old bank books. I've got one down here somewhere. It's just a bit of fun, really. But there you go. So thanks for listening, and I hope that's been useful for you. Pass that on. The main lesson tonight is to look for the best deals on savings, but also make sure you're not paying 18, 20, 30% and 40% and even 90% out on credit with payday lenders and loan sharks and that sort of thing. And how you can avoid that is by having an emergency contingency fund. Big companies have it, councils have it. Councils have millions of pounds in reserves. And when I was a council, I said, what do you need all this money for? I said, well, we don't know what's going to happen. It's disaster relief money. They can survive a year or more on their reserves. Most people can't even survive a month on their reserves. And if you talk about people like reserves, what are reserves? They haven't got a clue. So there you go. Have some reserves and avoid that bad credit deals. Thanks for listening. Bye for now. Thanks for tuning in, everybody. Thanks to Bunty there. Hi Bunty, Manny, and John, and David. Good to see you all. And Jojo, yeah, great to see you. I think we've got people tuning in as far away as the Philippines even. Great to see you all. Thanks for listening, and bye for now. Check out my book, Yes Money Can Buy You Happiness, on Amazon if you get a chance. And I will speak to you again soon here on Facebook Live. Thanks a lot. Good night.